Hi guys. Last time we talked about moving from a risk concentration to risk sharing models. Okay. Today, actually, this morning, I read a good article from San Francisco Chronicle, talk about the wildfire and triggered me to think more on this. But before I go on, I want to make a note of it. Last time, remember, I told you two figures. One is that from 1964 to 1990, each year we had like $100 million loss from the wildfire. It suddenly boomed from between 2017 to 2018. We had $20 billion loss from the wildfire. That's 200 times bigger loss. So last time I said something, basically blame everything on the climate change. I want to add note to it. It's not completely that. To make the story more complete, we have to think about something else. That's something called people are moving to the harm's way. That's very important. Just because we remember that in the between before 1990s, okay, there are only like 1 million people living in the area that's called Wildland Urban Interface (WUI). But by the like 2010, we had 2.6 million people living in those WUI. Again, wildland urban interface. That's basically you're moving into harm's way because you are moving into vulnerable places. The bad news is that nobody remind them or advise them to think twice before moving closer to the forest, closer to be surrounded by the trees and the forest. Okay, that somebody should have mentioned that to so they can be aware of the risk. But bad news is that nobody says that. So now we face the situation. What do we do? We have no choice. We have to, we can't force people back. Say, hey, you guys moved in the harm's way, so why don't you move back to the same place? That's not going to work. And also, keep in mind that even in the cities, like in the San Francisco, we have people, moved into regular insurance market to fair plan. So that's asking people moving back. It's not an option. The only option is for us to think what we can do, the insurance business, insurance industry, what we can do to work around that, to accommodate that reality. Now let's talk about the topic between risk concentration and risk sharing. Okay, there are two kinds of risk concentration scenarios. The first one is the geographic risk concentration. That's the case that we talked about last time in San Francisco. Safeco is moving out of the city or moving out of the state, right? But their case fits into the scenario of geographic risk concentration, meaning that in the same neighborhood, same area, they have written too many policies belong to the same next to each other, so make them risky to the same wildfire risk. Okay, so that's one type, geographic risk concentration. Another one is much bigger, which is a risk policy risk concentration. That basically means that we have something called all-in-one policy, cover everything under the sun for the same home, and then that's what get it risky and dangerous. This is very important because geographic risk concentration is not nearly as popular as or as big an issue as the policy risk concentration. So likewise, when we talk about the risk sharing, we also have two types. The first one is the first one is within carrier risk sharing. Okay, this is what we have been doing all this time for centuries, for decades, for years. We actually were doing is that, so for example, insurance company may have a 1 million policyholders, right? So within the 1 million people, and some people will have a loss. Most people, hopefully, most people don't have a loss. So you basically those people not having a loss is subsidizing people with the loss, kind of a socialism, right? So that's the one thing we call within carrier a risk spread, because all the 1 million people belong to the same carrier or insurance companies. We call them carriers. Okay, that's one type. The second one is the one that we've been talking about is between carrier risk sharing. That's basically the Super Bowl insurance model. That's basically the fair plan risk sharing model. Basically we put several insurance companies, several carriers together and say, hey, let's do this, let's work together, let's divide the risk and then let's share with them. So that's the two type. What's the biggest problem with the risk concentration model is that it has a fear. The insurance, the carriers all have fears. They're worried, they're scared of the risk overexposure because you are covering everything under the sun for the same home, and then it could go like $1 million because, for example, in the fair plan where the coverage cap is $3 million. Okay, but if your fair plan is only $3 million, we can safely assume that the regular insurance market, their coverage cap will be more than $3 million. Why? Because we know the fair plan has two features. Number one, the coverage is limited, the lower cap. Okay, they don't cover that much risk, but for the regular risk, we do cover more. So I won't be surprised if some home at $5 million, even higher. Okay, so that's one feature. Number two is that the fair plan. The second feature is that their coverage is limited. Basically, they cover fire, smoke, and lightning, and that's pretty much it. And we don't cover liability, we don't cover burglary, we don't cover vandalism. The hail and the windstorm, those kind of things. A lot of things they have a very limited. So all I'm saying is that the insurance company, the carriers, they have a legitimate reason to be worried about their risk, right? Because after all, they have to cover everything. So what if they do with the fear, with the scared, with being scared? What they do, they ended up, treating the risk of loss the same as the loss. So, example, if your home is risky for wildfire, I basically treat you as as if you will have a loss for sure, even though in reality that we always have uncertainty. We can never say this home, despite they have a dense vegetation, despite they have a vulnerable stuff in the house, it's not saying that this home will be burned next wildfire. So there's uncertainty. But for the insurance company, they don't care. They don't want to take the risk. That's the problem. Here is a very good example to back up that they have a fear, they are scared. We have a number to support that. Thanks for the San Francisco Chronicle report this morning. They have some figures to show. They did some homework to find out that over 50% of the people, their policy has been dropped by insurance carrier not not located in a high risk area. So that's very important. That's very interesting, right? Why would the insurance company doing that? Even though they know they need a bigger risk pool to keep it more profit, right? Keep it safer. If your risk if your risk pool is shrinking, that means that you have no choice. You have to, when there's um, some loss happened, you have a few other people to be able to subsidize people with the loss. So that's to your disadvantage. It's a loss to you and also to your customers. Why would the people drop in the policy? There are two issues here. One theory, according to the California Department of Insurance Commissioner, Lara is an interesting last name. His theory is that the people, you have to understand how the fair plan works. Last time I said that the fair plan works as a private syndicate, meaning that they are sharing the risk of loss. So when they also do that based on the market share. So if your company is the number one biggest carrier in California, then sorry, you have to pay more. Then the next one, who is the second biggest market share, then they pay less than you, and you keep going down this way, right? So one theory, according to the commissioner, the insurance commissioner, that people, insurance companies, they don't want to be the market leader, because if they're the market leader, then that means that when there's a loss happened in the fair plan, they have to pay more, even though that particular loss may not happen within the same area that they provide coverage. So that's the one theory. I can buy that, except I want to add one note to it. The thing that I want to add to it is that you know it's not insurance concern, it's not a carrier's concern for you to move you into fair plan, right? Because they can actually where it's better, so that because in the fair plan they can charge you higher premium, right? So meanwhile they can reduce their market share, and so they take less responsibility in case loss happened in the fair plan. So they're basically hitting two birds in one stone. The other problem with from this fair plan model problem is that it's kind of not fair, because, for example, I'm State Farm. I'm number one home insurance carrier in California. Just because I'm number one in the state, it does not mean for that particular